Welcome back to Gold Rush Reporter, everyone. Before we dive in, make sure to hit that like button and subscribe if you haven't yet. It helps the channel grow and it keeps you in the loop on all things precious metals. Now, let's get into it. The ghost has awakened for the final week of 2025, and the market action is absolutely undeniable. Silver is on a tear and it's taking no prisoners. Typically, the last week of December is known as Ghost Week. Trading volumes tend to be light, markets quiet, and activity subdued. But 2025 has proven that tradition wrong. COMEX, LBMA, and all the other major trading platforms are running red hot. This is a rollercoaster ride in real time. Bullion dealers, like our channel sponsor, Summit Metals, are reflecting this frenzy. While inventory is tighter than usual, they still have silver available, which is important for anyone looking to position themselves physically. Links are in the description below, and they can also facilitate sales if you need liquidity. Although ideally, selling silver should only be done to seize opportunities elsewhere, pay down debt, or meet pressing financial needs. As I record this, gold is trading slightly higher, up 0.34%. And earlier in the session, it spiked as high as $4,400. The current trading price is $4,348.10, up $14.70. But it's silver that's stealing the show. It rallied to $78.10 before pulling back to $76.22, which is still a $4 gain in a single trading day. That's a 5.55% jump. Platinum also recovered strongly, rising 85, up 4.03%. Palladium is the exception, trading lower, while rhodium is coming to life with a nearly 6% gain, up $500 to $9,450. What's driving this volatility? Supply disruptions, industrial demand, and fear trades in the paper markets are all converging. CNBC and other mainstream outlets only cover part of the story. While speculation about macroeconomic or geopolitical drivers is common, there's a critical dynamic happening behind the scenes. Silver's movement is increasingly reflecting structural scarcity rather than just market sentiment. Futures contracts surged 7% today, with March delivery climbing 7.2% above $76 per troy ounce, bringing 2025 year-to-date gains to 158%. Silver even hit record highs overnight, approaching $84 per ounce before giving back a significant portion in the largest single-day drop since February 2021. Despite the extreme swings, over 10% intraday, it's historic. Jeff Kilberg, CEO of KKM Financial, called it unprecedented, highlighting the intensity of this trading action. Macro perspectives, like those from Florian Ilopo at Lombard Old Year Investment Managers, suggest that in 2026, commodities gains may diversify. Growth acceleration could shift focus away from defensive precious metals to cyclical commodities. But let's be real. Precious metals retain their safe haven status, especially for long-term holders. That's why my older silver bars, purchased decades ago at just a few dollars per ounce, remain a core part of my stack. Even when measuring price volatility in dollars, gold and silver are fundamentally stores of value. Gold futures, for instance, recovered from Monday's sell-off, while copper trades hit record highs near $5.63 per pound, reflecting robust industrial demand. Meanwhile, geopolitical tensions, inflation hedging, and a weaker US dollar continue to attract buyers globally. But day-to-day moves are often influenced by factors less visible in headlines: fear, paper speculation, and supply constraints. China's silver export rules, often sensationalized, are actually just procedural changes, not full-scale restrictions. Some hype exists around these moves, but in reality, much of the silver is still circulating domestically. Investors must separate noise from fundamentals and understand the difference between paper trading and physical silver demand. This is the key. silver isn't just rising because of fleeting headlines. Its structural scarcity, industrial necessity, and investor demand are converging to create real upward pressure. Core holders, those with diamond hands, literally holding silver tightly, are insulated from short-term volatility. This is wealth outside the system, unmanipulated and enduring. Let's focus on what's really happening behind the scenes with silver. The numbers from December 29th are staggering. Over 1.38 billion paper ounces of silver traded on that single day. To put that in perspective, global annual silver mining production is only about 820 to 850 million ounces. That means more than 160% of the annual mined silver was traded on paper in just one session. This isn't about liquidity or price discovery. It's pure paper speculation. COMEX recorded 277,392 silver contracts traded, while the LBMA handled 1,257 deliveries. Compare that with the physical market, and the gap becomes even more apparent. One day of trading is equivalent to almost double the annual production of silver worldwide. This kind of volume creates extreme volatility, and it's why you see intraday swings of 10% or more. It's not about fundamentals in the short term. It's the detachment of paper trading from the physical reality that's driving the madness. Now, why does this matter for stackers and investors? Because it's precisely the contrast between paper silver and physical silver that creates opportunity. Physical silver is finite, tangible, and outside the system's manipulation. When market participants realize the disconnect between paper and physical markets, demand for real ounces intensifies. That's why holding a core silver stack, bars, rounds, or coins is so important. This isn't just about riding a wave of price volatility. It's about securing wealth that cannot be undermined by derivative speculation. Industrial demand also adds pressure. Silver is critical in electronics, solar panels, EV batteries, and data centers. Elon Musk himself highlighted its importance recently, and the market is taking note. The more silver is needed for technology and industry, the less there is available for investors. Physical scarcity isn't a hypothetical. It's happening in real time. And while paper markets can fluctuate wildly, physical supply is finite, which sets the stage for long-term upward pressure on prices. Let's talk about core stacks and diamond fist holding. This isn't just a phrase, it's a strategy. You hold silver tightly, not necessarily forever, but in a disciplined way that insulates your wealth from systemic manipulation. Whether the markets spike or collapse, your core stack remains untouched, preserving value. This is the ultimate hedge against uncertainty, and the difference between speculation and true investment. It's also worth noting how much of the market movement is psychological. Fear trades, panic selling, and herd mentality often exaggerate price swings. A 7% intraday jump or a sudden 8% drop doesn't always reflect the underlying fundamentals. What it does reflect is human behavior amplified by leveraged paper contracts. That's why understanding both sides, the emotional, speculative side, and the structural, physical side, is crucial for informed investing. Moreover, these paper markets aren't isolated. They feed into futures, options, and ETFs. While these instruments offer liquidity and hedging, they also magnify swings and sometimes create illusions of supply that don't exist physically. COMEX and LBMA numbers illustrate just how divorced paper trading has become from real-world silver availability. Another important factor is year-end timing. December 29th, 30th, and 31st are notorious for heavy flows as institutions adjust positions, hedge, and rebalance portfolios. The sheer volume of trades during the ghost week is historically significant. Normally, this week is quiet, but the 2025 close shows the market is anything but normal. It's a warning. volatility will continue, and physical silver demand will only grow as awareness of these dynamics spreads. In summary, the silver market is a battle between paper and physical, speculation and reality, fear and fundamentals. Knowing this distinction is the key to navigating volatility and protecting your wealth. Core physical stacks insulated from the noise give you security and leverage as paper markets fluctuate. This is where true investors differentiate themselves from traders chasing short-term gains. Let's break down the historical context of what we just saw and why it matters for stackers. The December 29th trading volume of 1.38 billion paper ounces is not just unusual, it's unprecedented. To put it bluntly, it dwarfs anything seen in modern silver market history. Past spikes of over 1 billion ounces were rare events, often tied to extreme market stress or massive hedge fund activity. Yet here, we see paper trading exceeding the annual global mine supply. That's a warning flag. Why does this matter? Because silver is a physical commodity. Paper contracts, futures, and ETFs cannot create new ounces. They merely represent claims. When market participants focus too much on paper, the true scarcity of physical silver can be masked. But for savvy investors, this is an opportunity. Understanding that only a fraction of traded silver actually exists physically allows you to position strategically. Those holding real ounces are insulated from the volatility of the paper market. Consider the concept of leverage. Many of these paper trades are leveraged multiple times over. 1 ounce of physical silver might back dozens of paper claims. This amplifies every price move. The swings you saw, a single-day jump of 7%, then a collapse of over 8%, are magnified by this leverage. The emotional reaction of traders chasing short-term gains adds fuel to the fire. But for those holding physical silver, these moves are largely noise. The only variable that truly matters is availability of real metal. The industrial demand side is equally critical. Silver is not just an investment. It's an essential input in multiple industries. Electronics, solar panels, EV batteries, and medical devices all rely on silver. According to various reports, industrial consumption accounts for roughly half of annual global silver demand. This consumption is steady and growing, particularly with the green energy revolution. Supply constraints in combination with rising industrial demand create upward pressure on physical silver prices, independent of paper market manipulation. Now, let's talk about timing. Ghost Week, the final days of December, is traditionally low volume because traders are away. But 2025 was anything but normal. Heavy trading volumes during this period indicate institutional activity, likely related to end-of-year hedging, rebalancing, and speculative positioning. For retail stackers, this signals that volatility will continue well into early 2026. It also highlights the need for patience. Short-term swings do not reflect long-term value in physical silver. The takeaway here is simple. Focus on core physical holdings. A diamond fist strategy, holding tightly, maintaining control, and ignoring the noise, is the most effective way to protect wealth. This is not speculation, it's preservation. Those who panic sell during spikes or dips are responding to emotions, not fundamentals. In contrast, disciplined stackers understand that silver's intrinsic value lies in its physical properties and finite supply. Historical trends reinforce this approach. Previous periods of intense paper trading, such as 2011 or early 2021, eventually led to physical squeezes. When demand for real ounces overwhelms available supply, the market reacts sharply. In these moments, paper prices may diverge from physical reality, creating arbitrage opportunities for those prepared with tangible silver. These patterns suggest that similar dynamics could play out in 2026, particularly given rising industrial demand and growing retail awareness. Finally, consider the psychological component. Fear, speculation, and herd mentality dominate short-term price action. Institutions exploit this, moving prices in ways that appear erratic to retail participants. By focusing on long-term fundamentals, holding physical silver, and avoiding the trap of measuring wealth in fiat terms, investors can navigate volatility without stress. Weight, not dollar value, becomes the key metric for stacking and long-term preservation. Now that we've laid out the trading dynamics and industrial demand pressures, let's dive into what this means for silver's trajectory heading into 2026. The first thing to understand is that these rollercoaster moves are not random. They are a product of extreme leverage, shifting market sentiment, and the increasingly visible scarcity of physical silver. Every swing in the paper market highlights how disconnected it is from tangible reality. For long-term investors, this is an opportunity, not a threat. Consider the March 2026 futures trading over $76 per ounce. While day-to-day moves can be 5 to 10% in either direction, the trend is unmistakable. The underlying fundamentals are tightening. Physical silver inventories are limited. Global mining output hovers around 850 million ounces annually. Yet one single day saw over 1.3 billion paper ounces traded, well over annual production. This disconnect means paper market volatility may continue, but it cannot erase the finite nature of the metal. Those holding ounces are positioned for real gains, especially as industrial demand grows. Industrial use is more than a minor factor. It's a critical driver of price. Silver is essential in solar panels, electric vehicles, data centers, and medical equipment. As renewable energy adoption accelerates worldwide, demand will outpace supply unless new mining operations scale quickly, which is unlikely given environmental and logistical constraints. The scarcity is real, and so is the price pressure. Investors ignoring this are underestimating a key aspect of silver's long-term story. Ghost week trading also serves as a warning about the fragility of paper markets. When trading volume spikes unexpectedly in traditionally slow periods, it signals institutional maneuvering, end-of-year positions, portfolio rebalancing, and speculative bets. These moves can create massive short-term swings, but they do not reflect changes in fundamental value. Retail investors should see this as a signal to remain disciplined. The only price that matters is the one you pay for actual physical ounces. Let's talk about strategy. For core stackers, the focus should be on accumulating physical silver consistently, regardless of short-term price spikes. Volatility is a feature, not a bug. When paper markets overshoot, it's an opportunity to add to your stack at relatively favorable prices. Holding a diamond fist, tightly gripping your physical silver, protects wealth from both market manipulation and fiat currency erosion. Weight, not dollar value, is your true measure of wealth. Education is another critical factor. Herd mentality can be dangerous. If new investors flood the market purely chasing high prices, they risk making emotional decisions, creating temporary bubbles that could collapse sharply. Experienced stackers who understand the difference between paper and physical markets and the underlying scarcity of silver have a massive advantage. Teaching newcomers to prioritize fundamentals over hype strengthens the entire community. Now, consider price implications for 2026. While some macro analysts suggest that commodities might lose some safe haven appeal in a re-accelerating global economy, silver's dual role as both an industrial metal and a store of value ensures ongoing demand. Short-term swings may be dramatic, but long-term trends are dictated by real-world supply constraints, industrial adoption, and the growing importance of precious metals in a weakening fiat environment. Finally, psychological discipline cannot be overstated. Every spike, dip, or flash crash is amplified by human emotion and leverage. Staying calm, focusing on ounces, and ignoring the chaos of paper markets is what separates successful stackers from panicked traders. The silver you hold today, whether a single ounce or hundreds, is wealth outside the system, immune to manipulation, fiat devaluation, and market hysteria. As we wrap up this analysis of the final trading week of 2025, it's essential to focus on the bigger picture. Silver is no longer just a speculative asset or a hedge. It's becoming a cornerstone of wealth preservation and industrial necessity. The chaos in the paper markets may grab headlines, but the physical reality is clear. Silver is finite, highly demanded, and increasingly recognized for its dual value as both an industrial metal and a store of wealth. Looking at the numbers, it's almost unbelievable. One single day of COMEX trading saw 1.39 billion paper ounces change hands, exceeding total annual global production by 170%. That's pure leverage, pure speculation, and in many ways, pure noise. For those holding physical silver, these spikes are opportunities to measure the strength of their position. Each ounce you own is tangible, immune to the manipulation and volatility of paper markets, and directly linked to real-world supply and demand. The role of industrial demand cannot be overstated. From solar panels to electric vehicles, electronics to data centers, silver is woven into the infrastructure of the modern economy. Elon Musk and others in the tech sector have highlighted the critical need for silver in these technologies. As clean energy adoption grows, as EVs become ubiquitous, and as data centers expand globally, the demand for silver will rise steadily. Mining output, constrained by environmental, logistical, and geopolitical factors, cannot keep up indefinitely. This structural imbalance points to a long-term bull case for silver that goes beyond short-term market speculation. Ghost Week volatility also serves as a reminder of the risks in the paper market. Sudden spikes and drops are often orchestrated by institutional flows, margin adjustments, or speculative bets. These moves can be dramatic, as we saw with over 10% intraday swings, but they are temporary. Retail and long-term investors must focus on what matters most: the accumulation and preservation of physical ounces. Weight, not dollar value, should be the measure of wealth. Another critical factor is education and herd behavior. New investors entering the silver market often react emotionally to dramatic price movements, chasing gains or fleeing losses. This herd mentality can amplify volatility and create temporary bubbles. Experienced stackers, who understand the distinction between physical and paper markets and the finite nature of silver, hold a strategic advantage. Educating newcomers and emphasizing fundamentals over hype strengthens the community and supports long-term stability. Looking ahead to 2026, the fundamentals remain clear. Even if macroeconomic conditions shift, with some analysts expecting commodities to face cyclical pressure, silver's intrinsic value as both a practical industrial metal and a hedge against fiat devaluation is undeniable. Short-term price swings will continue, but the long-term trend is toward higher recognition of silver's scarcity and necessity. In practical terms, stackers should focus on disciplined accumulation. Set targets for physical ounces, acquire consistently regardless of paper market noise, and hold tightly, the diamond fist approach. This ensures wealth preservation, protects against inflation, and positions investors to benefit from both industrial and monetary demand. Avoid panic selling or speculation-driven purchases. Your focus is the tangible weight of your stack, not daily market headlines. Finally, the closing message for 2025 and guidance for 2026 is simple. Silver is finite, valuable, and increasingly essential. Hold physical ounces, educate yourself and others, and approach the market with discipline and clarity. The chaos in paper markets will continue, but informed stackers are insulated from volatility and poised to benefit from the ongoing silver story. To all viewers, thank you for staying informed, engaged, and committed. Rate, comment, share, and subscribe to continue building a knowledgeable and empowered silver and gold community. Here's to a strong finish for 2025 and a prosperous, well-positioned 2026 for all stackers. Hold tight, stack smart, and remember, wealth measured in ounces endures.